Joining us now with more analysis on all of today's economic and market developments, Mohamed El-Erian. He is CEO and co-chief investment officer at Pimco. It's the world's largest bond fund company. Mohamed, great to have you with us. You heard our report, and that investors are buying stocks on reassurances from central banks pumping money into their economy. So, is this stock market rally healthy, and what are investors in for when things reverse?
So this rally, which has been a wonderful rally, has been driven by three factors. One, you're absolutely right, a ton of liquidity being injected by central banks. Two, technicals. There have been inflows into the asset class, people that were underinvested. That has boosted prices. And three, and much weaker, the fundamentals. Today, finally, we got good news. Last week, unfortunately, the news was less good. So we've come so far based mainly on central banks. In order for us to stay here and go further, we need the fundamentals to pick up. We need the economic conditions to validate the high prices. Otherwise, this wedge that the central banks have created between fundamentals and prices will be very difficult to maintain.
So what we've got, Mohamed, if I'm understanding you, we've got lots of liquidity, but we have a deficit of real economic growth. Why hasn't the extraordinary sort of experimental policies that have been undertaken by the central banks around the world, why hasn't it produced growth? Can it? And what happens if it doesn't?
So three reasons why it hasn't, Tyler. One is called the liquidity trap, that you're in a situation where you need to put a ton of liquidity in there in order to trigger a response. Two, we still have structural impediments. So we emerge from the crisis healthier. We can walk as an economy at about 2%, but we can't sprint because of structural impediments. And then third, there's some genuine question marks about what will the tax system look like in 2 to 3 years. So companies are holding back. If this continues, and if we don't get the response that allows companies to drive up their revenues and maintain their profits, then we will have an issue because prices would have disconnected too far from fundamentals.
All right, so what does all of this mean for investors and what they should be doing? Number one, you run the world's largest bond fund. So I want to know what you're doing with the clients that have, bond portfolios. What should individuals do with their bonds? And I know you run stocks too, so what's your advice on stocks? What should investors be doing to position themselves right now?
So at these levels, and given that we're starting overweight risk, so we've been benefiting, our clients have been benefiting from this rally, at these level of prices, we are walking away from risk. We're not running away, we're not sprinting away because central banks are committed, but we're walking away. So we're taking money off the table because we think that there may be better opportunities. We also are keeping an eye, and this is very important, on the liquidity conditions. We saw some very strange behavior in markets in the last few days that raise questions about the functioning of the markets. So we think that this is a good time to walk away from risk, not run, walk away, especially if you've started with an overweight position in risk assets.
What was the unconventional behavior that you saw? Elaborate on that. That sounds very interesting, Mohamed.
So we're seeing liquidity break down in certain segments of the market. And Tyler, we pay very close attention to the functioning of the market. And we're seeing a liquidity desire that's cascading across different segments, that's putting certain...
Where precisely?
So for the high yield market, for example, today, there was an issue that there wasn't as much liquidity as you would normally expect. So we're keeping a very close eye. Now, a lot of people will say, well, that's normal because, after all, when central banks are no longer just the referees of markets, but are also playing on the field, they're going to change the functioning of markets.
Mohamed, I just want to follow up on what you said, walking away from risk assets. What do you put in that category? Like, is gold in that category? Are some stocks in that category? What do you mean?
So mainly stocks, high yield bonds. If you look at the absolute level of yield, Susie, as opposed to the spread, the absolute level of yield, there's a real question mark as whether that compensates you now for the risk. It's funny, but if you watch people when they are suggesting you should buy things, it's no longer about the fundamental value. It's only that it's cheaper than something else, right? But at some point, cheaper than has to be supported by fundamental value. And we're a little bit worried that the disconnect is getting too big.
Okay, all right, we're gonna have to leave it there. Thank you so much, Mohamed. It's always a pleasure to have you on the program.
Thank you.
Mohamed El-Erian of Pimco.